Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax accounting and business advisory firm. This week with Robert Salter and Neil Insull.
Happy New Year!
Hello and welcome to The Tax Factor, the UK's top tax podcast. I'm Robert Salter.
Hello, and I'm Neil Insull. The tree is on its side in the back garden. The decorations are safely in the loft. The family-sized tin of celebrations is down to a couple of bounties. So it must mean Christmas is over and the new season of The Tax Factor. I'm delighted to be here with Robert. It's the first time I have been on this Tax Factor with Robert. It's a bit like playing Luke Littler at darts. It's an overwhelming privilege, but I will be outplayed this afternoon as I do this. So thank you, Robert, for joining me today. What I wanted to ask you, Robert, is, we're a few days into the new year. We're still thinking about Rachel Reeves. I was thinking about her over Christmas through my turkey lunch on Christmas Day. And I was wondering whether you felt that she might have some New Year's resolutions.
I certainly can't help but think that Rachel Reeves is probably questioning again her budget and some of the issues she's done there and the impact that's perhaps having on the economy. What we heard over Christmas is the economic news isn't that good. I think that leads into, is there any implications or changes which are needed from, say, an NIC perspective, for example, where the employer NIC charge, which is coming down the line, is going to have some implications. What are your thoughts, Neil?
I mean, Rachel's not been out of the news for a few weeks now, and I think we're going to hear her name on a daily basis for quite a long time to come. I mean, just to recap what was announced on budget day, there were three main changes. There was an increase of the employer's NIC rate from 13.8 to 15%, and at the same time, she announced a reduction in the threshold at which NIC comes into play for on a person's salary, down from 9,100 to 5,000. And then there was a third announcement, which was an increase in the employment allowance to 10,500. And this all happened at the same time as announcing an increase in the national minimum wage. So this was to raise 25 billion in extra taxes. And at the time, everyone gasped in a sort of like, how on earth can she possibly do this? And what would there be repercussions? And I think we're beginning to see some of those repercussions now. I think there's been certainly reports in the press, in the media generally, about lack of business confidence being reported amongst service providers and exporters in particular. There's the S&P Global UK Services PMI, which is the Purchase Managers Index, which reports essentially what businesses feel about the UK economy at the moment, their confidence in the growth prospects. And that's been at an all-time low for quite a long time now, and was reported this month as saying that 1 in 4 employers in the service industry are expecting to reduce the number of their employers. So there's definitely a squeeze on employment at the moment and expected hires and people not looking to replace leavers. So I think there is a really quite alarming signals from the UK business services sector suggesting things are not well. And at the same time, this week, we've heard that the yield on 30-year gilts is now at a 27-year high of 5.35%, which demonstrates falling confidence in the UK government and economy generally. And at the same time, we're getting potentially inflationary moves from Trump in the future. So not all Rachel's fault, I don't think, but there's certainly significant and very serious repercussions from the announcements back in October.
I certainly agree it's not totally her fault, but, there's no doubt there's going to be inflation, possibly from a Trump perspective, caused by him. But if you look at increasing the national minimum wage significantly, we'll have further kind of implications for those on slightly higher wages, as employers probably need to raise it for everybody else. Clearly, they'll try and pass some of the increases onto employees or the more general public, in effect, realistically. So again, there's going to be that kind of UK-created inflation. So I think it's going to be an interesting time, shall we say, for her and for the British economy.
Yeah, next the retailer, they announced that they were going to spend another 79 million, I think, alone because of the increase in the NIC rate, which meant that they were likely to increase prices of their goods by another 1% in 2025. So inflationary impacts as a direct measure of the increase.
Yeah, and I know Waterstones, for example, said, okay, if we're doing 6.7% for, the minimum wage, so the people on the minimum wage, well, they're going to have to do the same 6.7% for all their other employees as well. So again, and that's not going to be unique. And clearly, if Waterstones do it, other retailers may feel a need to do it as well. And in that situation, clearly, you're going to have to push up prices somewhere.
Indeed. Worrying times.
Yeah, it's going to be a challenging time. And obviously, talking about the cost pressures facing business, that we've actually got also another case dealing with the issue of tips, for example, trunk master arrangements in the hospitality area. Not specifically a tax case behind this, but it's a case of the big table company, which is basically Bella Italia, Las Iguanas and everything like that, and the arrangements that they have for their waiting staff and the staff in their, eateries in terms of, the tips that they receive and, how that's going to be taxed, not actually taxed, actually how that has to be paid when it comes to things like holiday pay. The case, which is a first tiered case, so it's not absolutely binding, but it is clearly a sign of how the courts are looking at these things, held that the tips which the company was paying count as basic pay for holiday pay purposes. So, if you're in the hospitality area, there's every chance that your employees now can say, actually, were you including the tips that we paid in terms of the holiday pay you were paying us and things like that? Now, you might say, well, hang on, we're not guaranteeing these tips or anything like that. And certainly in this case, everything that the company was doing was correct from an NIC perspective, from a kind of a tax perspective. But the issue was that you've in effect got a disconnect here between what is basic pay or taxable pay from an NIC perspective for employers' NIC purposes and what is basic pay when it comes to employment rights. So in effect, there's this disconnect. And again, that just creates additional complexity and additional cost for employers. So, you can be doing everything right from a payroll perspective when it comes to the NIC, the PAYE, etc. But basically, that doesn't mean you can ignore it when it comes to calculating basic pay for holiday pay. And realistically, other areas, so maternity pay, for example, may in some cases be caught by this as well. I'd like to say it's a first tier case, so you can potentially say, actually, does it apply to our situation? But I think there's certainly some concerns from a budgetary perspective. You may have other employees coming along and saying, well, hang on, it applies to me. Can we backdate this, please? And on a go forward basis, then you've got to try and understand what could we do to try and manage that exposure. Could we do things, for example, and say, okay, make sure the trunk master arrangement is outside the contract. In the case we had here, there was reference to this in the individual's employment contract. So if you take it out of the employment contract arrangement and just do it, is that potentially a way of trying to avoid this in the future? Clearly, we'll have to kind of wait and see, but I think it's something you need to be aware of as an employer if you're in this hospitality trunk kind of master situation where tips are clearly an integral part of somebody's pay from a kind of common sense perspective. I think you need to be asking the questions and saying, okay, what do we need to do? If anything, are we willing to accept that actually it's only a first tier case, it's not binding, and we'll live with the danger of challenge? But it needs to be considered.
Yeah, I think I read this case with quite a lot of interest, partly because I think we all acknowledge when we go into a restaurant, sometimes the tip is a really important aspect or part of the overall payment that we make for the services that we're getting from our waiters and so on. The one thing that I read about this is that this applies where the tips are paid through the payroll, but to the extent that they might be paid in cash, is that this might be outside of that. There might be a different treatment for cash payments rather than payments that are paid through the payroll.
Yeah, so it's almost like punishing the company for having been more organised about the whole system.
Yeah, exactly. It's an odd one. I would have thought that put it this way, if I was a fair and equitable employer, I would be wanting people to share in those tips, and even when working out the holiday pay. It would seem to be fair in making that assessment.
I think you could absolutely justify, paying the tips as holiday pay and things like that from an ethical perspective. But clearly it's an additional cost pressure when particularly the hospitality industry is probably going to be looking forward to 2025 or not looking forward to 2025. If you think about hospitality, I think it's probably one of those that's looking forward to 2025 in the kind of a very negative sense, given, the wider cost pressures and tax pressures that are coming down the line.
I'm all about ethics, Robert. I'm a very ethical person, as you know. So shall I talk about another?
Please do.
Couple of first-tier tribunals. On a totally separate subject, this is to do with corporation tax. So we're moving into another area, something that I deal with occasionally, but this is to do with R&D, research and development tax credits. Now, I've looked at R&D tax claims for many years, and it's become quite a complicated area. And in fact, there's new legislation that's come in, which has change things around. And actually, the new legislation since 24 isn't directly applicable to the cases that have been decided recently on whether certain expenditure should be qualifying or not for the tax credits. The two cases are concerning two companies called Collins Construction and another one called Stage 1 Creative Services Limited. They claimed R&D tax credits in relation to the R&D work that was going on. I don't think the revenue had any concerns that the type of expenditure was not qualifying, but they did have an argument that the expenditure should not qualify because it was either subsidized expenditure or contracted out expenditure. And if you're an SME, a small and medium-sized entity claiming under the old scheme, you would not qualify if the expenditure was one of those two categories. Now, in this case, what the revenue were arguing is that the expenditure that was being incurred was expenditure that would not have been incurred had it not been for essentially the work that had been specifically asked for in relation to the customer's contract. And the revenue were basically saying that because of the fact that this was directly related to the customer's request, the expenditure was effectively being subsidized. It was being met directly by a third party and therefore fell within the definition of subsidized. The tribunals in both cases rejected the revenues argument on this. They went back to the decision which was reached in an earlier case called Quinn, which Quinn won, and the court said that there needed to be a clear and direct link between the payment from the third party, in this case the customer, and the qualifying expenditure. And they said there wasn't that direct link. Just because work was being carried out for a customer, it didn't mean that there was a direct link there. And the revenue then said, well, there's a second argument for disallowing the expenditure or not qualifying the expenditure, and that's because it's contracted out. In other words, the company conducting the R&D was performing the R&D on behalf of their client. And in that case, the SME tax credits would be disqualified. And the revenue was saying that even if you weren't winning on the subsidized point, you'd lose because you're essentially doing this R&D for your client. The client would otherwise have done this R&D if you were not doing it. And the revenue dismissed that completely and said, that's crazy. Your customers don't know what the R&D is doing. That's not their business. Your customers are completely outside of this R&D world. They're relying on you to do the R&D and it's nothing to do with them. So they're saying that this is not contracted out. It's a crazy argument. You lose on that point. So the revenue lost on both of these points. And our understanding is that there's plenty more companies that are currently under inquiry and have had discovery assessments raised in relation to this particular point. We also understand that the revenue will not pursue this to the upper tier tribunal. They will contact those businesses that have the same issue that these two taxpayers that went to the tribunal have, and they will presumably drop their cases and they will be issuing new guidance in their manuals in relation to this. So this hopefully puts to bed a particular problem which was throwing a lot of companies into a lot of uncertainty because their R&D claims were being disallowed under the SME scheme, which is worth quite a lot of money. I should say that the legislation has changed now. Contracting out is a different definition, but this actually just demonstrates perhaps HMRC's overzealousness to deal with certain R&D claims, basically on the back of what was considered to be abuse of the system. But, my view on, I don't know, Robert, how much you look at R&D, but my view on the R&D legislation is it's very messy. It's overly complicated, always has been. It was, it's almost as though you've asked someone to invent a bicycle, but put the saddle on. It's totally not user-friendly. It's a real mess. I would, in many ways, prefer to see no R&D tax legislation than bad tax legislation. And hopefully some lessons have been learned and the revenue's attitude towards R&D tax claims is going to be better in the future.
I just wonder, how many people are or companies in effect are in this kind of limbo at the moment where they're still in negotiation with HMRC. And obviously, I think my concern is that, HMRC have dropped the appeals in this case and everything like that, and they're going to have announcements about how to go forward. But whether that's got out to all the HMRC inspectors and everything like that is a doubt on my side. So I think the challenge or the question or the issue for companies is, if you're in discussions with revenue about this general area, don't just kind of give way. Make sure you at very least hold off until the fuller final announcements are published by the Revenue, probably in February, then decide about the next steps. But just don't kind of give way, because clearly for a lot of companies, the money at stake is significant. In these two appeals, it was almost £4 million worth of tax. So it's a big figure. There's going to be a lot of companies out there in a similar situation, waiting a month, making sure you let HMRC officer or whatever know. You're waiting until the formal feedback comes out in a month's time and then decide what next. Can you win these cases, or actually is it actually not cost effective to continue pursuing or whatever, but wait and see for the formal guidance to come out?
Yeah, and I think the point here is that also, and I can't agree with you more on that, is that hopefully a lot of these companies have good tax advisors. Maybe they have Blick Rothenberg.
Touch wood, as the saying goes.
You know, how many companies are looking at the results of first-tier tribunals? Probably not. Only their advisors will be, and it will be the advisors who tell them exactly what's been going on. It won't be the HMRC.
Talking about technology, we can lead on to, in effect, online trading, which is an area which has kind of created a lot of publicity over the last few months, because obviously the government changes online trading regulations and what needs to be reported by the likes of eBay, Vinted, Gumtree, etc. to HMRC. And that actually comes into effect now, in effect. So we're actually looking at the legislation, or looking at the period back to January 24 to December 24. But basically in this month, as we speak, the eBays, the Gumtrees, the Vinteds, etc. will be having to report details of online trades to HMRC. And that's basically going to be for trades where there's been a value of cumulatively by X individual of over £1,700, or that individual has had at least 30 trades via that particular online portal, online website. It won't necessarily impact people who've had 5 or 6 trades here, 5 or 6 trades there, but where you've had £1,700 or more, all those 30 trades or more through eBay or whatever particular entity, that information was going to be now shared with HMRC for the 24 calendar year. I don't think in itself that's controversial. If you are genuinely trading through those websites, you're probably also trading through other sources and everything like that. Profits need to be reported to HMRC. So that, I think, is going to be not controversial, and it needs to be kind of timely done. Hopefully people have been doing it anyway. But I think the kind of the focus I've got is, obviously there's been a lot of hearsay out there, a lot of noise out there, which has just been misleading in terms of, if you sell your children's old secondhand clothes on eBay or whatever, you're going to have to do a tax return. The good news is, if that's genuinely just clearing out the seller, clearing out the loft, etc., that's definitely not the case. That is not trading, and you won't need to do anything in terms of reporting the money to HMRC or anything like that. Clearly, there's going to be some confusion or uncertainty between what is just a hobby or clearing out X, Y, Z and what is genuinely trading. So again, that's the sort of area where I think it's going to have some noise and confusion over the coming months and coming years, I suspect, because you're basically going to be taxable on profits you make from online trading or any trading where you are genuinely trading. Now, that could be provision of a service, it could be selling stuff. But if it's just a hobby, actually you're not liable to the selling on that. Or if it's just an investment activity, you're not selling. And there's no clear division here in the UK tax code as to what is trading compared to what is a hobby or just investment. So there can be, I suspect, some cases going forward on that area. I think the other related area is, obviously you may have just cleared out a lot of stuff and it may have had 30 trades or something like that. So you may then get notifications from HMRC saying, hang on, you need to do a tax return or something like that. And that's where I think there's going to be a noise again, where some people may suddenly need to think they need to do a tax return. They may even be asked by HMRC to do a tax return, and it may be sensible, therefore, to do it, but you may not have a liability. So I think that's going to be something that's going to be very interesting over the next few months as HMRC kind of goes through all this data they receive from the eBays, the Vinteds, etc., and then start contacting people.
Just wonder whether HMRC's resources could be put to better use. That's all I think sometimes.
Well, yeah, and clearly, there's going to be some people who are trading and are taxable, but in a very small way. So if, for example, you're selling a spare bedroom on Airbnb, that will be notified if you're having it sold for more than 30 nights a year or whatever, separately. The chances are you can get the first £7,500 of kind of rental room relief is available. And actually, that doesn't therefore need to be reported. But it's like, yes, you may need to report it now because you get contacted by HMRC. So just as the final kind of closer for today's meeting, I would like to remind people it's January. You need to do your tax return. So if you're doing it yourself or you're using an advisor, please do it ASAP. I've had to do tax returns before at midnight, basically on the 31st of January, and I certainly don't want to be doing that. So please get your tax return in ASAP. Thank you.
The Tax Factor from Blick Rothenberg.
That's all we have time for this week.
As we've been away, I get the housekeeping job to remind you that we release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever is most convenient. We record and release them in less than 24 hours, no less. So you always get the very latest news and updates.
If you enjoyed the podcast, please subscribe and give us a rating or review. Next week, we have Hannah and Melissa, who will be in the Tax Factor shares. Thanks for listening, and we hope you enjoyed the episode. It's goodbye from me.
And it's good night from him.
That's the Tax Factor. If you enjoyed the Tax Factor, please like, share, and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.